Today I wanted to talk about mortgages. It's common in the financial media to hear about the benefits of paying off mortgages, and when this idea is presented, it's often done to show the interest savings over the mortgage period. I mean, it's a sensible argument, especially when you package the idea of risk reduction as a paid-off mortgage normally represents the largest debt for most households. People just naturally want to pay off their debt, right? However, I rarely hear the argument against paying off the mortgage early. In this video, I wanted to show what inflation does to a mortgage, and I think this is the lost argument that people tend to avoid. The idea here is to demonstrate that when you factor in inflation, a mortgage with a long term actually works out in the home buyer's favor. I'm going to use the Ostermiller mortgage calculator to demonstrate the power of inflation on mortgages. So what we're going to do is take a look at the mortgage calculator now. You can see here that for my demonstration, I'm using a mortgage principal of $275,000. I'm using a 30-year mortgage term with a 4.0 mortgage interest rate, which is about standard for 2015 right now. It's fixed, of course, and the expected yearly inflation rate is going to be 3.06%. Now, you normally don't see this in a lot of mortgage calculators, but it's really critical, and we'll see in a second here why. Down below, you can see that when I'm calculating this, my monthly payment works out to $1,312, and down at the bottom, you can see total payments of $472,000. So there you have the total amount. Now, this hasn't been adjusted for inflation. Now, if we look to the column to the adjacent right, you can see the amount adjusted for inflation. So if we take a look down there at the total payments, now rather than seeing the 472, when we're adjusting this for inflation, it gets down to $308,719. Why is that? Why is it so far out? Well, the reason why is because inflation eats away at the dollar in the future, right? So the purchasing power is less and less and less as time goes on. The longer you extend the term of the mortgage, the more inflation gets to chew away at it. And if you really start to think about this, this is why the bank does not like to give long mortgages. Why? Because it puts them at risk for basically inflation risk. If inflation goes up, it erodes their capability of being able to use the money or to use the future interest earnings. Now, let's take a look at the second tab that I have here. What I did is I decided that rather than going ahead and pay the full 30 years or waiting for the full 30-year term, I'm going to throw an extra $100 every month into my principal. And so what this does in turn is it pays down my interest, right? So I'm actually putting more dollars towards my interest. If we look down at the bottom, now you can see here that, my interest payments went from, they were in the prior tab, they were at $197,000, and now it's down to $169,000. So I drastically reduced my interest payment, right? Wow, that's great. Look at the total payments, $444,000. Okay, so my total payments went down a little bit, went down to almost $30,000. Now, here's the trick though. Look at the amount adjusted for inflation under the total payments, $305,000, right? Well, before it was $308,000. So when we adjust this in terms of real dollars, in other words, the real dollar spending amount that we're using currently, there's not that much of a difference between the two, despite the fact that the total payment was drastically down. So maybe this is just a trick. Maybe if I paid more, I would see a bigger savings, right? So what I did on this third tab is I actually adjusted this to paying a whopping $400 extra every month. And now you can see here that my amount adjusted for inflation for the total payments, $297,000, right? So think about that for a moment. When we did nothing at all, adjusted for inflation, we were at $308,000 for just the 30-year. When we tried throwing an extra $100 at this a month, the amount adjusted for inflation was $305,000. When we went to $400 a month, the amount adjusted for inflation was $297,000. That's not a big change. So the thing to think about here is whenever you're spending today's dollars on your house, the more money you spend, the less money you're able to put elsewhere, whether it's in savings, whether it's investments, or whether it's just in general budget. I mean, maybe you have health expenses, car expenses, whatever. The argument that paying your mortgage earlier is necessarily a better financial decision, I'm hoping to show you here is somewhat mitigated because inflation is actually helping you over the long term. So the thing to really think about here is paying all that money up front for the principal on your mortgage worth the what I would call the budgetary pain, because you're taking it away from other expenditures such as, being able to invest in your kid's 529, or being able to invest your money, or being able to get that car or do repairs on your house. Is the pain of being able to sacrifice all that just to go ahead and pay down your mortgage worth it? I would argue that if you look at the inflation side of this equation, maybe not. Maybe you should actually be contemplating how you could best use your money now while it still has that strong purchasing power, and let inflation do the eroding for you on the term of your mortgage. Of course, there's always risk on this. You might lose your job tomorrow. You might have something catastrophic go on. But there's also risk on the flip side, right? If you're not putting money away into savings and something catastrophic does happen and you've got all the money sunk into your house, wow, I hope you have a home equity line of credit on your house, because you can't take the money out of the walls, right? Once you've sunk the money into that mortgage, it's basically locked in there and you're not getting it back out. So there's risk in both directions for this. There's just not the risk of, oh no, my mortgage might get foreclosed on, or I might lose my job. There's risk on the other side of this too. So it's something to seriously consider and evaluate both areas. Me personally, I would rather be taking my money and putting it into a 529, or taking my money and putting it into my 401k, or taking my money and doing anything else, because I know over the long haul, inflation is going to work in my favor. It's going to reduce this. I know that over the term of my working career that I will constantly be getting raises, right? Increasing my spending power of the dollars, and being able to work against that mortgage, that the value of the mortgage that I currently having right now. By the time I get to the end of my 30 years, I know that $275,000 is going to look really small. And you know something? The actual mortgage payment 30 years from now is going to be looking really small. So I'm not worried about that at all. I hope this helped you.